welcome to the show. We're working through these 5 sort of early tax trends, but the reality is I think these are going to be trends that folks are going to see across the board this tax season.
Yeah, absolutely. So we've already talked about higher interest rates, both received and paid. We talked about dividends and capital gains. And then we're moving on to the next one, which would be Social Security. So your Social Security benefits that you receive, the taxation on that is based on your additional income. So if you have no other income other than Social Security, chances are you're not taxed. However, if you have other income in addition to your Social Security gets taxed at different rates up to 85%.
Well, and that's exactly kind of what happened on this return that I looked at this past week that went from owing zero the prior year to owing over $4,000. Those higher dividends and capital gains, which again are passed through proportionately as an owner of the fund. So if the fund owns a couple hundred different companies in it, and these companies are paying dividends, or maybe there's some transactions inside the fund that then create capital gains. And in particular, you see that after a few years where you've had a nice trend in the markets, where then these numbers really start to really be much bigger. And that's exactly what was happening with this person's return, is that because of the dividends and capital gains, her Social Security then became taxable, which then really has a pretty significant accelerating impact on the total tax picture.
Yeah, absolutely.
It's interesting about that Social Security tax. I mean, as you were just describing, you have to get above certain thresholds in order for it to be taxable. And I think it's important to know, and I guess relate it back to the current headlines where we're hearing the conversation out of Washington about, we want to make Social Security tax free. Well, for some Americans, it is tax-free, particularly if you're below those thresholds. But what's unique about those thresholds is that they really haven't changed for well in excess of 40 years.
Yeah. Many tax codes are adjusted each year due to inflation. However, Social Security brackets are not.
Yeah, so what that means is then that every year more and more Americans, because this hasn't been inflation adjusted for a 40-year period of time, more and more Americans are seeing that their Social Security is taxable, whereby previously it wasn't. And I guess that ties into the headlines. This current administration is talking about, I want to make Social Security tax-free. What's interesting is I think they can accomplish a lot just by sort of fixing this glitch, I guess, in the tax code, whereby the thresholds just index them to inflation, and you'd pick up millions of Americans and put their Social Security back to be non-taxable, which is sort of what was originally contemplated, but the code hasn't kept up with inflation, and so more and more people unfortunately experience their Social Security to be taxable.
I mean, you make it seem so simple, but I'm sure we will spend, we meaning the government, much more time to fix that issue.
Yes, and there'll be a lot of headlines about it, and it will be, a new concept, if you will, but in fact, it's, an age-old concept. It just needs a little bit of adjustment. One of those rare things in the tax code, there's a few. That's probably the biggest one where there was not an inflation adjustment at all during the course of the time, where Social Security is typically treated on the return. So
we'll definitely due for that.
Yeah. Absolutely.
Do.
So what's next? So we're continuing on with the early tax trends that we're seeing at the office at Nelson Financial Planning.
Yes. So the next one we have is something we're kind of seeing folks use across the investment world more and more. It's called a qualified charitable distribution, also known as a QCD. And a QCD is where you take a redemption out of your IRA account, and those redemptions are paid directly to a charity of your choice. And when you do it that specific way, the redemption from your IRA is then non-taxable to you. Still reportable, but it becomes non-taxable.
So that's a great feature.
Yeah. Absolutely. So we've seen a lot of our clients, especially those of RMD age, if they no longer were able to itemize, they use this qualified charitable distribution to help get a little bit of a tax break on their tax return, and it's a way, in essence, to still keep track of your charity and get a little of a deduction for it. So the key components with a QCD is, as I said before, it must be made payable to the charity. It's one of the most important parts. It cannot be made payable to you, and then you bring the check to the charity. It has to be made payable to them. And one key factor is it does not have to be your RMD, or you don't have to be of RMD age. The QCD option starts at 70 and a half. So we're actually starting to see some folks realize that, whether we're explaining that to them or they realize it on their own, and they're able to get some deductions for those charitable contributions.
Yeah, definitely some logistics, though, that folks need to observe on this stuff, and specific process that they need to follow in order to make sure that it's done correctly.
Yeah, absolutely. Absolutely. One of the other key components is that you can only give up to $108,000 through a QCD per year. Now, that is a large amount, but if you do donate and that's the way you would like to spend your money, it's a great feature to save some money tax-wise.
Yeah, no, it really does, and it's a feature that's been around for a few years, but I do think it's important to kind of include it on this list of sort of early tax trends, because more and more people are starting to realize, as you were saying, the value of doing that. And it's great to see that trend. It's great to see that from a charitable giving perspective, but also great to see where folks are able to be much more tax effective or tax efficient by using this QCD approach.
Yeah, absolutely. I mean, I think that's where using a tax professional comes in to help utilize these approaches and just make sure you're doing it the correct way.
So the next up on the list is this whole Form 1099-K thing. Tell us a little bit more about that, Christina.
Yeah, so a 1099-K is a form that you would receive for goods or services that you perform during the year, whether it's from credit card or debit card transactions or online payments such as Venmo or PayPal. In the past, these forms had a threshold of $20,000, so many folks did not get these issued to them. But the IRS is changing the guidelines, and then starting in 2024, it's going to be a tiered system. So for 24, the guideline for getting this form is $5,000, and then it'll go down to $6,000 for 2025. Yeah,
it's going to be pretty low threshold for this year.
Well, even dropping from 20,000 to 5,000 is quite significant.
Catches up a lot of people. Be prepared. If you get that, then make sure you're putting that on your tax return. You may need to take a little bit of time to find it as well, because more often than not, these are through online, some sort of online or app type of provider, like a Venmo or similar.
Yeah, like a
app.
Venmo or PayPal, maybe like an Etsy or eBay, something like that, where they're not sending out forms electronically, and that's an issue we're seeing across many of our tax forms with clients providing us information, is that they're no longer mailing them out. You have to download the form and somehow get it to us.
Yeah, especially for those, the natural tendency is to select e-delivery. So you're right. I mean, a lot of it is you've got to, you may say, oh, I didn't get a tax form. Well, that's probably not enough in today's world. So you need to really dig into making sure that you found it. A couple weeks ago when Chuck Howard and Kristen Costello of Nelson Financial Planning hosted the program, they had a really in-depth discussion about this 1099-K stuff. So we would encourage you to go into the podcast archives and listen in on that if that's at all applicable to you. Really spend some time kind of working through this issue. And I think the key takeaway to remind people about, Christina, is you got to look for that form. That form is not magically going to come in the mail to you.
Yeah, absolutely. You have to look for the form. And one of my favorite comments to say to people is, just because you didn't receive it doesn't mean it wasn't issued to you. No. And the IRS does not care that you didn't get it in the mail. And I think the other key factor, too, just real quickly, is to note that you can write off expenses on it. So if you are a business, it in essence turns into like a Schedule C, like a business schedule. So you can write off some expenses. So it may be something you're not used to doing, and you need to make sure you're prepared for.
Absolutely. That is changing. IRS wants to know about everything that you do. That's the whole point of the 1099-K. Anyway, we're going to take a break and continue here on Dollars and Cents with Joel Garris and Christina Lamb of Nelson Financial Planning.